A stock doesn't jump more than 50% intraday because it suddenly became real. In a Nasdaq microcap, that kind of move is often the market reacting to structural pressure, not celebrating fundamentals. The drivers are usually the boring, dangerous ones: listing compliance, capital access, dilution math, and the uncomfortable truth that sometimes a company's most valuable output is runway. This story is about Nauticus Robotics, Nasdaq, KITT, an American subsea robotics and autonomy software company. Offshore subsea work is expensive, risky, and operationally unforgiving. If autonomy can reduce vessel days, human exposure, and the cost per underwater intervention, it can reshape offshore economics. Nauticus sells that promise through 3 offerings. Aquanaut is its autonomous underwater robot for subsea missions with reduced human tethering. Toolkit is its autonomy software layer, positioned as a modular kit that can be deployed not only on Nauticus systems, but also on third-party work-class ROVs. Olympic Arm is its electric subsea manipulator, positioned against traditional hydraulic manipulators for complex precision tasks. Investors care about this stack because hardware-heavy robotics tends to scale slowly and burn cash, while software, if broadly deployable, can scale faster and potentially support higher margin, more recurring revenue. Toolkit is the hinge. If it truly spreads across platforms, the business model can shift from project-driven hardware economics toward platform economics. But the snapshot numbers put the thesis under financial gravity. KITT was shown around 1.1 per share, up roughly $0.4 on the session, over 50%, with an intraday range around 0.7 to 1.2. The 52-week range was shown from roughly 0.7 to roughly $54, the kind of discontinuity that often reflects corporate actions and microcap liquidity-driven repricing. Market cap was around $15 million. Trailing 12-month revenue was around $5 million. Trailing 12-month net loss was around $110 million. When losses dwarf revenue, external capital stops being a side story. It becomes a core driver of outcomes. The stock becomes a vote on ownership math as much as a vote on technology. That sets up the fundamental mystery. Why can a microcap rally hardest when dilution risk appears to rise? The answer is in sequence, and in what is normal versus unusual. On September 2nd, 2025, Nauticus announced a 1-for-9 reverse stock split. In typical healthy company situations, you see forward splits 2-for-1, 3-for-1, after strong runs to keep the share price in a convenient band and broaden liquidity. Reverse splits are usually defensive. They lift the price mechanically by shrinking the share count, often to manage listing optics and the dysfunction that comes with very low price trading. Reverse splits do not improve margins or reduce cash burn. They buy breathing room. Investors interpret them as fragility signals because they often appear when management is fighting penny stock gravity rather than scaling from strength. Then, on October 23, 2025, Nauticus disclosed it had received a Nasdaq deficiency notice stating it was not in compliance with the minimum market value of listed securities requirement, the $35 million threshold, based on a notice dated October 16, 2025. Under standard exchange procedure, a deficiency notice triggers a remediation window. The company must regain compliance within a defined period and may submit a plan or request a hearing. The key point is that time becomes procedural and outcomes become nonlinear. Investors must price a distribution of outcomes, remediation, extension, restructuring, or worse, rather than assuming continuity. Now, the unusual cluster that reframes the stock: survival access to equity capital. On October 24, 2025, Nauticus filed an 8K describing entry into a standby equity purchase agreement, an equity line of credit type structure, up to roughly $250 million with registration rights provisions. On October 27, 2025, the company emphasized roughly that same $250 million facility again publicly, framing it as financial flexibility and tying it to strategic messaging, including deep-sea minerals and rare earth opportunities. Around the same October 27th period, communications referenced converting roughly $4 million of debt into equity. To see why this is unusual, compare it to the normal case. In healthier companies, financing facilities are typically sized relative to operating cash flow or an established earnings trajectory, and equity issuance is one option among many. Here, a roughly $250 million equity facility sits next to a roughly $15 million market cap, an order of magnitude mismatch. That mismatch implies the company has built the capacity to expand the share base dramatically if it uses the facility heavily. For management, this can mean survival insurance and reduced near-term failure risk. For shareholders, it creates a dilution overhang, future supply that can cap sustained rallies and compress the per-share claim on any future success. Debt-to-equity conversion has the same dual nature. In the normal case, it reduces near-term cash pressure and leverage, improving solvency optics, but it can dilute shareholders by increasing the equity base. When reverse split, deficiency notice, large equity capacity, and debt conversion commentary happen close together, investors infer that runway and compliance resilience are being engineered. That is not automatically bearish. Survival is prerequisite to commercialization, but it changes the lens from product adoption to ownership math. So why can the stock still spike upward? 3 grounded hypotheses explain the paradox. First, the market can reprice survival probability faster than long-run dilution. With roughly $5 million in trailing revenue and roughly $110 million in trailing losses, the immediate existential risk is liquidity. A large equity facility can reduce near-term going concern anxiety. Short-horizon participants may buy that reduction in left-tail risk, even while long-horizon investors worry about future share count. Second, microcap liquidity and momentum can dominate. With market cap around $15 million, liquidity can be thin and price impact large. A burst of demand can trigger momentum scanners, short covering, and follow-on flow. The candle can look like information when it is largely microstructure and attention. That's why the move feels mysterious. Price behaves like it knows something, even if it is simply reacting to flow. Third, traders may be betting that runway becomes a bridge to proof. Nauticus has emphasized technical progress and early commercialization signals. In the Q3 2025 period, it highlighted toolKITT being used in a paid commercial job on a third-party ROV and discussed subsea operational capability. Third-party deployment matters because it suggests toolKITT might scale beyond Nauticus hardware, expanding addressable market. But investors must remember what is normal in robotics commercialization. Demos lead to pilots, pilots to repeated pilots, then to sporadic early paid engagements, and only later to recurring contracts. Offshore subsea raises the bar. Integration complexity, uptime requirements, safety standards, and procurement friction are unforgiving. One paid job is meaningful, but not proof of repeatability. The unusual ambition, productizing autonomy across platforms in a fragmented ecosystem, could be transformative if it works, but remains uncertain until the pattern repeats. Technical analysis adds a discipline layer. One public technical readout placed the 200-day moving average around 1.5. With the stock around 1.1, price remained below that long-term regime boundary. In typical technical practice, reclaiming and holding above the 200 days supports a more durable trend transition. Staying below keeps rallies vulnerable. In a microcap with perceived equity overhang, the boundary can matter more because participants may expect supply to appear into strength. Profit-taking, skepticism, or anticipation, the company can raise equity into rallies. A practical framework follows from the rounded snapshot. With price around 1.1, intraday high around 1.2, intraday low around 0.7, and the 200-day around 1.5, short-term traders may treat a clean hold above roughly 1.2s as a continuation signal and a failure back below roughly $1 as a risk boundary. Upside waypoints include roughly 1.3 and then the 1.5 zone. Swing traders often treat $1.5 as a decision wall, reclaim and hold, ideally with a retest, supports higher confidence positioning. Repeated rejection supports mean reversion toward the lower range around 0.7 to 1.0. Long horizon investors should anchor to repeatability and dilution management. Multiple paid deployments, clearer revenue cadence, and evidence capital access is being used as a bridge rather than a treadmill. If you have a stock, a pre-IPO name, an exchange-listed small cap, or a coin whose story feels like it has hidden wiring, something that doesn't add up between the chart, the filings, and the headlines, leave it in the comments for the ValueStir channel. Be specific. Drop the ticker or the name, tell me what feels off, and tell me which event or number keeps nagging at you. The more concrete your tip, the more likely it is we can build a real timeline and test the narrative instead of guessing. And if you're one of the listeners who keeps coming back, who subscribes, hits like, leaves thoughtful comments, and shares these episodes outside this platform, thank you. That support is the reason this channel can keep going deeper, stay more rigorous, and return the favor with better content. And the mystery, stated cleanly, is this. Nauticus Robotics may be building real subsea autonomy, but the stock has been driven by survival dynamics. Reverse split on September 2nd, 2025. Nasdaq deficiency disclosed October 23rd, 2025, based on an October 16th, 2025 notice. An equity facility described in an October 24th, 2025 filing and emphasized again on October 27th, 2025. And debt-to-equity conversion commentary around roughly $4 million. The market can rally because survival is prerequisite to commercialization. But the same survival tools can dilute the per-share claim on commercialization if it arrives. That tension is why the candle is loud and conviction is fragile. The market may be buying runway, while investors are still waiting for repeatable proof. This was ValueStir.